Kia ora, and welcome to the CoreLogic Property Market Update for August 2021. Another month into the year, and yet further evidence of the market slowing, albeit relatively gradually. The quarterly rate of value growth at the end of July was 5.9%, a drop on the recent peak rate of 8.1% at the end of April. This is the lowest quarterly change since November last year, when the market took off in response to all the support and stimulation provided by the government and Reserve Bank in their fight to minimise the economic impact of our aggressive defence against COVID-19. This gradual slowdown is reflective of a reduction in affordability. As values have continued to grow out of step with incomes, and interest rates have started to increase, fewer people will be able to borrow the money required to buy at the current prices. This will be felt around the country to varying degrees, and we may already be seeing this, with some areas coming quickly off very high rates of growth. Both Gisborne and Kapiti Coast experienced quarterly value increases in excess of 10% at the end of June, but these have pulled back to 2.1% and 3.3% respectively at the end of July. In fact, the quarterly rate of growth reduced for 20 of our largest 21 centres, with Nelson the only exception here. The rate marginally increased from 4.8% at the end of June to 5.0% at the end of July. Many areas are at all-time highs when it comes to most unaffordability measures, well ahead of any historic averages. At the nationwide level, the typical time it takes to save a 20% deposit now exceeds 10 years, and in Auckland, it's more than 12 years. Meanwhile, the prolonged recent growth phase in both Wellington and Dunedin has seen the measure in these areas also exceed 10 years for the first time. The years to save a deposit measure continues to be a very relevant figure to track, as deposit requirements are set to tighten yet again. In early August, the Reserve Bank proposed a lower allowance for owner-occupiers securing finance with a high loan-to-value ratio, or LVR. Currently, banks can do 20% of new lending to owner-occupiers at greater than 80% LVR. In other words, with less than a 20% deposit. However, the proposal is to reduce that allowance to only 10% of new lending to owner-occupiers with less than a 20% deposit. This change is likely to hit first home buyers the most, with the Reserve Bank's own data showing over 3/4 of all owner-occupiers who use the less than 20% allowance are first home buyers. Put another way, 38% of all first home buyers in June secured their first house with less than a 20% deposit. This is equivalent to more than 12,000 buyers in the last year. With tighter requirements, fewer of those buyers will be able to be active in the current market. Further, we have seen first home buyers recently take advantage of reduced competition in the market, as investors deal with their own harsher LVR requirements and the phased removal of interest cost deductibility. According to our buyer classification series, first home buyers picked up a record share of purchases in July at 25.8%, equal to August 2020. With the changes afoot, it's unlikely their share will remain this high, which will be of real interest to the government, who have been very clear in their desire to assist more first home buyers into the market. Alongside the proposal for tighter LVR requirements, the Reserve Bank has also confirmed they now have the ability to consult and introduce debt to income, or DTI, limits, though we're unlikely to see them this year. A mandated serviceability interest rate floor has also been discussed, and is more likely given its relative ease in introducing, due to the banks already having their own serviceability test rates. From an interest rate perspective, we're firmly in the phase of increasing interest rates now, after roughly 7 years of declining rates. In their most recent monetary policy statement, the Reserve Bank left the OCR at 0.25%, but they were clear that this was purely because we had gone into the snap lockdown. Had we not had the Delta variant enter our community, we would have seen an increase in the OCR, and as soon as the current restrictions are lifted, the OCR will follow. This is clearly evident from the Reserve Bank's OCR forecast. Coming off the back of already increasing interest rates, this will only advance further increases, which mortgage holders need to prepare for. It's truly amazing how quickly things change. Only a month ago, the debate was whether we'd see the OCR lift this year at all, and now there could be as many as 3 adjustments up. The strength in the economy, low unemployment, and high inflation have all contributed to this pace of change, and I wouldn't bet against expectations changing further as the year plays out. At this stage, we don't expect rising interest rates to be enough on their own to cause property values to drop, as many people should be able to adjust their spending to compensate for higher mortgage payments. That's assuming unemployment remains low and there's no global financial crisis style credit crunch. Demand to buy may well reduce, and property market performance will vary across the country. but the overarching feeling is one of value moderation rather than outright falls. What's more, with residential construction activity strong but slow and listings remaining very low, it's hard to envisage an oversupply anytime soon, especially without motivated vendors willing to take a price cut to shift a property on. Of course, we've already seen expectations change wildly week to week, let alone month to month. So make sure you subscribe to the New Zealand Property Market Podcast and regularly check the news tab at corelogic.co.nz to keep across all the changes as they unfold. Mā te wā.